And today we are doing a live Q&A session. Lots of cool things going on. I've had a lot of questions come in this week about Index Universal Life, about whole life insurance, some comments that have been made that are not exactly accurate by certain people. And so I'm going to set the record straight on a lot of that. And some of the comments, some of the feedback that I get, it's a lot of times it's really hard for me to engage with those comments on the chat thread because it's just so much. It's so involved. It's really hard sometimes to really set the record straight or do a full explanation that gives it justice, right? Like to the explanation, to the topic, because I'm not a big fan of kind of taking shortcuts and giving half-baked explanations of things. And so, you know what, what we're going to do today is we're going to go into a lot of Q&A. Before I do, one of the things that I want to do, I'm not sure if you're here, if you're a life insurance agent, if you are somebody who's looking at getting into life insurance, but if you are a life insurance agent and you are here, I want to encourage everybody. I put a thing on the chat, and you can go to planner.life180.com. I just launched a new planner. I call it the Agent Success Planner. If you are a life insurance agent, this is the planner that will help you reach 6 figures in income. And you'll do so by serving people in a more powerful way. It's not about just selling and managing your day. It's about actually knowing how to add value to the people that you're looking to serve. That planner will really help you. I'm launching the Life 180 Challenge. We got a lot of things going on that are really, really positive. I don't really ever go live here on Sundays. I'm usually at church right now. My family and I went to church yesterday, and so I had the morning off. I'm actually going up to Vegas in about an hour and a half. So I got about 45 minutes to do this. And so what I have here is I'm going up to Vegas. I'm getting a tattoo. I'm going to get like a half sleeve, for a tattoo. It's going to be cool. I've never done a tattoo. It's a long story. I'm going to document it on the YouTube channel and on my Instagram channel tomorrow. It's going to be fun. But I'm really excited about that. Really nervous, a little bit scared too, if I'm going to be real. But what I want to do to start this is let's get into having a conversation about Index Universal Life, about whole life insurance. And what I'm going to do to start this is go through my comment section. Now I'm going to open up behind the curtains here, and I'm going to let you guys see kind of what I have going on. And if you're on TikTok right now, by the way, just if you want to see the screen that I am sharing, you got to go over to YouTube and check it out. So before I get started here, Adi Ratanuelu. All right, I'll try. Don't say that 10 times fast. All right, so I'm a new life agent. And I already have IUL and follow you. About to offer whole life better to the prospects, but it depends on if they want IUL. Yeah, okay, so, all right, let me do this. So here's what I'll say. This happens a lot, right? Like, so people get into the business and they join an organization like PHP or WFG or PFA or, one of those IUL IMOs. And then they, maybe they got their IUL for themselves and they're trying to figure out what the best solution is moving forward. And then, they find me or they find somebody else and they start to realize like, oh, there's this other tool out there that is whole life insurance that can be utilized in these different ways. And it's maybe a better solution. Maybe you feel more comfortable about it for all the reasons that I preach and for all the reasons that I shifted my whole practice and my whole life from being a huge IUL advocate to being probably one of the #1 IUL adversaries on the internet. And now I strictly focus on whole life because I gotta be able to put my head on my pillow at night. So if that's you and you kind of ran into that, I would say our job as life insurance agents is not just to sell people to make a commission. It's to be able to identify people's challenges, identify what their goals and objectives are, and help them solve solutions to be able to solve those challenges and help them reach those goals and objectives. And I think a lot of times people may want IUL because that's what they've been marketed. That's what they've seen. That's all they are aware of. And so I think it's a matter of, not leading with product, but starting with process and starting with the end in mind ultimately, and understanding, that your job is to help them solve a problem. One of the things, and I'll start with this. One of the things, and I'm going to share my screen here. I'm going to go back to my board. And I think the people on TikTok should be able to see this as well. But what I want to do here, let me just open a new tab here. If it works, there we go. All right. So one of the things that I think is really important here to understand is this concept of human life value. So whenever we're thinking of life insurance, even cash value life insurance, we have to be coming through the lens of we have to be thinking about solving the need of human life value first, right? So what do I mean by that? I mean, if you take somebody that's earning $100,000 per year of income, the life insurance company is going to maximize what they're able to do. Now, I have a problem with any life insurance agent that says you should just dump all your money into a whole life policy or all your money into an IUL, because it's just not good planning. It's not financially responsible. What we need to be thinking about is saying, all right, what is the human life value on somebody that makes $100,000 a year? The life insurance company is going to say it's going to be anywhere between 20 and 40x your income. So that's really anywhere between $2 million to $4 million is the life insurance number that you can get. So my philosophy here is, let's not start with the IUL and whole life conversation. Let's start with the human life value conversation. Let's start with fulfilling your human life value, because what we're doing when we do this is we're saying, obviously, what is the purpose of what we're doing? I believe any plan that we have should be designed to fulfill an objective, right? And so your objective, whenever you're doing any kind of financial plan, is to help accomplish a goal, help reach financial freedom, help reach retirement, make sure your family's taken care of, make sure your legacy planning is good, all these different things. And the beautiful part about utilizing whole life insurance as part of that plan is that it's a way to guarantee that plan is going to happen. So right now, it doesn't matter where you are in your planning stages. If you earn $100,000 a year, the life insurance company is saying, hey, your future earnings potential is between $2 and $4 million. And so they're going to insure you for that $2 to $4 million. This is an opportunity for you to be able to say, hey, if the life insurance company is going to give me, let's just call it $3 million to split the difference, why would I not take advantage of that? Why would I not capitalize on that? But the thing is most people can't afford $3 million of IUL or whole life. You've got to be able to supplement with a term rider or even a term policy, like a term, I'll just call it a convertible term policy, just to keep it simple. So if you do that, we want to basically buy our net worth, our future net worth. You can buy your future net worth. I'm going to put NW for net worth. Buy your future net worth and then build cash flow. That is what we're talking about here. That is everything that we do. And when you utilize life insurance as part of a grander plan, that's what you're enabling yourself to do. You're enabling yourself to buy your future net worth and then focus on a strategy to build cash flow through real estate investing, business investing, or other assets. Now, if we, the question here on YouTube was talking, what happens if people are interested in IUL? Well, I think, when you start to realize that this is really the objective and the problems that life insurance will be able to solve, I think it becomes a no-brainer that you're utilizing whole life and not index universal life in the process. So I'm not sure, what do I got here? Any comments, questions on TikTok? Nothing so far. All right, so here we go. Everything's on YouTube right now. Anybody on TikTok, go over to YouTube, check it out, and we will go from there. I'll bring it back over here. So let's hopefully, Audi, that answered your question. I would just really encourage you, just because people say that they want IUL, don't take the easy layup all the time. Unless you believe in it. Listen, I don't believe in IUL, so I can't, in good faith, sell IUL because I just don't believe in it. And so my job, whenever somebody tells me that they want an IUL policy, I have to then turn around and try to just educate them as to what that would look like in their life, and really just take a step back and try to figure out, what problem are we trying to solve? Where are your values? What are your beliefs? What do you think is the world's going to be looking like? What do you need to do to be able to solve those problems? And what tools, what products do we need to be able to do that? And when we reverse engineer that, we start with the end in mind. Very, very seldomly do I find, when people really understand the moving parts of index universal life versus whole life do they want to do it? Now, I'm going to go to the next question now. What I'm going to do is I'm going to share this like I was doing before, and we are going to go into this. And so I'm going to just go through the questions here. And people, 19 minutes ago, I got this question: how long till you take a withdrawal money from it? How long till you take withdraw money from it? Okay, so that's a the wording is a little wonky there, but someone's saying you can dig into it within 30 days. I've never heard of that. Okay, so this is on my this is a comment on my old video that I did last year: how to properly structure a whole life insurance policy, updated for 2022. So yeah, the answer is you can access the answer is you can access capital in your whole life insurance policy if you design it properly within 30 days, pretty much across the board. I would say we've even had clients access it within 14 days. The one thing I will say is it's all variable based on how much money you've put into the policy, how you've structured the policy. Are you paying monthly? Are you paying annually? That's going to have an impact on how liquid that policy is. And so when we think about that, one of the things that I think is inaccurate that people talk about when it comes to whole life insurance is that they're basically giving you and guaranteeing the loan with the death benefit. I can't remember how people phrase it, but basically they phrase it, because I can't say it the wrong way. I've trained myself to say it the right way. But people basically insinuate that you're borrowing against the death benefit. That's the word. You're borrowing money against the death benefit. So that is a misleading statement to me, because they're not letting you borrow against the death benefit. You're borrowing against the cash value. So if I'm paying $10,000 annualized premium and I've designed the policy, I might have $8,500 liquid in the first 30 days if I've contributed $10,000 in premium. That might get me a $500,000 death benefit. And somebody, that when you think I'm borrowing against the death benefit, they think about that and they think maybe I have access to close to $500,000. And no, that's not how it works. What you're doing is you're borrowing against the cash value, but you're guaranteeing that loan against the death benefit. The life insurance company is utilizing the death benefit to guarantee the ability to give you that cashback loan. That is ultimately all it is, right? And so, that's something to, I think, understand, and something to not be confused by if you're watching other people talk about this. And I know a lot of people in the infinite banking space kind of, I don't want to say they misrepresent, because I don't think they're intentionally trying to misrepresent, but I do think it is a confusing statement when you're talking about you're borrowing against the death benefit, right? Because and they do that. It's important that you are borrowing against cash value, and they're guaranteeing that loan in case you die against the death benefit. That's just the way it is. So, all right, let's move on. I'm a new agent. I've only sold Mutual of Omaha IUL for the death benefit alone, so I haven't worked on structuring an IUL policy yet. Okay. Couldn't you simply structure it to decrease the net amount at risk as they age? I believe it requires some amount for it to remain a life insurance product, but if you reduce it down significantly, wouldn't you significantly reduce the risk and still serve the goal of tax-free income? Do companies allow that? Again, I'm very new and trying to do this. Yeah, that's cool. So great question. Okay, so how do I answer this? So the answer is, yeah, you can do this. There are certain things you can do to reduce the net amount at risk in retirement. You need to make sure that you're falling within the MEC guidelines to be able to do so. But here's the bottom line. The problem with IUL has to do with the actual income and the loan risk, right? Because you have the net amount at risk, and ultimately, let's say you start with a $500,000 policy, and you fund it for 20 years, and by the time you get to retirement age, your net amount at risk is only $100,000 because the cash value's grown, and it's just, I'm not going to get into explaining how that works, but here's the deal. as soon as you start taking loans against that policy, you're injecting a ton more risk. Now, I've done a lot of videos on this. I'm not going to get into super detailed response to this element of it because I've done so many videos on this, and I can just go check out my Index Universal Life training playlist 2023. It's on the Life 180 YouTube channel main page. You could see it there. It'll educate you as to all of that stuff, and I go through illustrations and I break down exactly how this works. What I will say with this is that you can reduce the net amount at risk, but as soon as you start taking loans against it, and you're typically taking index loans, not wash loans, even though everybody says, oh, the wash loans are great, but you still have the net amount at risk. If you do a wash loan, that means you're never eating into the net amount at risk, and your cost of insurance is going to go up and up and up and up. By the time you're in your 80s, it's going to be catastrophic to what you're trying to do for the policy. And so insurance fees eat into the performance and will make the policy lapse at some point in time. And if you do index loans, now the interest expense on the policies wind up becoming a massive liability to the policy. And then you run into potential lapse issues, right? Yeah, death benefit. All right, so hopefully that answers that. So death benefit is the collateral. So Mark, here's the deal: death benefit isn't the collateral. That's I mean, death benefit is what guarantees it. If death benefit was the collateral, then you would be able to collateralize all of it. You're not collateralizing the death benefit. You're collateralizing the cash value that you have, a portion of the cash value that you have in the policy. They're using the death benefit as a backstop to guarantee the collateral of the cash value, right? Like, so I mean, it's, once again, it's semantics, but if you say the death benefit is collateral, that can be misleading, because then people could look at that and they say, wow, if I got $500,000 in death benefit and I can use that as collateral, well, think about it. Do you not see how that could be misleading? The cash value is the collateral. They're using the death benefit to guarantee it. That's what I would say. So, all right. So somebody asked this question: how long did you sell IUL before I decided it was not the best way to go, and resulting embracing whole life insurance policies instead? So 4.5 years is what I did. So I started as a career life insurance agent with one of the bigger IUL companies. And then I worked there, worked my way up, became a manager, became the director of business development for a region, and started going around the country recruiting, training, and doing all that for the company. And it's still to this day one of the biggest IUL companies in the country. And so that said, it was about 4.5 years. About 4 years in, I had a conversation with a gentleman, and I've shared this story a lot, so I won't get into a lot of detail on that. Once again, you can go check out other videos if you want the full story. But what I'll say, all right, Mark, thank you. That's awesome. But what I'll say to this is, I was the biggest advocate. Everybody, and remember, when I first started, it was 2009, 2010, 11, 12, 13, when I was selling IUL. And at that point in time, social media wasn't really where it is now. I mean, sure, we had Facebook, but it's not even close. It wasn't utilized to create content nearly the way that people do now. And so there wasn't the information that we have now to be able to go and find it. So all I had was what I knew from the life insurance company. And so I took all their marketing, all of their sales training, and everything to heart. And I was like, whoa, this is the most magical thing in the world. When I first got into the IUL business, I was supposed to work with my father-in-law. And he was a Wells Fargo advisor, worked on the investment side of the business. And I initially was going to go work with him. And the only reason that I had to go get a job at a life insurance company is because of the fact that we're just coming out of the Great Recession. And his manager was like, Chris, I can't hire you right now. If I hire you, they're going to fire me. So you need to go get a job somewhere else. And I was like, what do I do? And he's like, get a job at a life insurance company, prove to me that you can do this for a year, and then come back. And then ironically, in that year, I fell in love with IUL so much that I stepped away and I walked away from a multiple six-figure succession plan with my father-in-law. He wasn't very happy about it, but that's how much I believed in IUL. And if you know anything about me and you watch my content and talk to my wife, if I believe in something, whether right or wrong, if I believe in it, I do my homework or whatever, I'm all in on pretty much anything I do. And so I was in and I did it. I walked away from the role with my father-in-law, and I joined this other company and stayed with them, went through the ranks, became a manager. And then you can imagine how it felt when I realized, like, holy crap, everything that I was doing for the past 4 years at that time wasn't what I thought it was. And I was wrong. And I had to have that conversation and admit I was wrong to my family, to all the people that I had sold, to my father-in-law, who I basically said, no, I'm not going to be your succession plan. You got to go to somebody else, that kind of stuff. Like, it was a really hard conversation. So anybody, I get the idea when you're selling IUL and you got into it. And I believe most people get into this business because they want to do the right thing. You're trying to serve people. You only know what you've been told. And unfortunately, the life insurance companies are the biggest part of this problem, because they are only pushing the sexy part of IUL. They don't tell you really the truth about what's going on behind the scenes. And so, the answer, so hopefully that answers that question. So Mark just asked, is there ever a scenario where IUL would be a good fit for somebody? That's a good question. I've brought a guy named Danny Romberg on. Daniel Romberg. He's an agent on our team. We do a lot of whole life business together. He deals with a lot of high net worth people. He actually has shown me a couple of ways that index universal life can work. Remember, I don't hate IUL. I hate the fact that IUL is misrepresented. I hate the fact that IUL is being sold as this great, simple cash flow vehicle tool, tax-free income retirement, cash accumulation vehicle. And the reality is it's not good for that. Like, that's where it's dangerous. IUL can be a good permanent death benefit if you utilize it for that. So one of the ways that Danny showed me that he utilizes IUL, and it's not with any of these regular companies, but it is an IUL chassis platform, is that you're doing single pay MEX in retirement with no need for the cash value, but it has a guaranteed return of premium, which, if you're doing a big lump sum single pay MEC, whatever you put in is guaranteed return of premium. So that means you can't lose on it. So I'm always looking, what's the upside? What's the downside? Can I live with the downside? And it gives a multiple factor on the upside of the death benefit. Now, he's never selling these with the goal for access to the cash value. Never doing it. The goal is always protection and legacy planning. That's it. So that is the scenario where it can work. And I could probably still make an argument on why whole life would be better in that scenario. But we did run some scenarios, and every now and then, based on health ratings and age and all this stuff, and how you're funding, and then how much front load we're talking about, there were a couple situations where IUL won, and that's it. So let's see here. Somebody I haven't read it yet. I'm going to put it up here. Can I please speak on those who recommend stuffing $90K loan at 3.5% interest into a whole life policy, making it $100,000 loan, giving you $5,000 return per year? Some call it the flex method. Some, and by some you mean, I think, Dan Thompson and that crew, right? So is that who you're talking about? Here, I'm going to leave this up here so people know what I'm talking about here. So this is an interesting one. This, to me, is like just an absolute atrocity. I've dealt with, here's what I'll say. I've dealt with several scenarios with clients that have gone through this process, the exact flex method. We actually helped a client who was a big NFL player get his money back from the companies, utilizing Penn Mutual and utilizing Emeritus. So they were utilizing Penn Mutual for whole life insurance, and they were using Emeritus for IUL. And this client was able to get, because of the fact that the flex method group was selling on non-compliant Excel sheets, that they were not explaining how it all worked. And they were giving this idea of 90K loans at 3.5%, which, by the way, you can't get 3.5% anymore. And that's one of the challenges. This is one of the reasons it's not compliant, because like, you sell off these Excel sheets and you can make anything look really sexy. But, when you look at IULs on the back end of everything, there's a lot of moving parts that you can never, ever, ever include in an Excel spreadsheet. So anybody says, hey, we've got this figured out. No, they don't. I promise you. And this just goes to prove the point. This guy was 3 years into his premium, massive premiums. Like, we're talking almost $1 million a year in premiums, very successful NFL player. And then yet when it got to this point, after 3 years of premium, so we're in year 4, the policy had not done what it was supposed to do. And there were all these issues. And so he was able to get his money back. And when we helped him navigate the process with Emeritus and Penn Mutual, because how they were misrepresented and missold and utilized non-compliant stuff, that's what made him able to do that. Now, like, this is what I have for a problem. Like, I don't know how, they were able to do this and they're able to sell based on this. Because, by the way, this is just bull crap. Like, you cannot do this. Like, it will not work. If you try to utilize life insurance in the flex method way, it will blow up in your face. Now, here's the deal. There was a window in time where it worked. There was a moment in time where circumstantially you could pull it off because of the rate environment. That it was not a principle-based, principle-driven way of utilizing life insurance. I only deal with utilizing life insurance strategies that are going to work absolutely, and that are principally driven, and that are not market circumstance driven, meaning low interest rate environment. Because like at the end of the day, we are buying and utilizing these strategies to solve long-term problems, right? To be a long-term solution and a long-term asset that we have that's supposed to make everything that we do better, right? Like at the end of the day, like when you buy into a strategy like that and then interest rates go up, you are fried. And I got news for you. Like, all of those people, there's a lot of premium finance stuff. Like Kaizen is another strategy that worked for a window in time. And they were basically selling premium finance to all these people that looked really good. And it looked good on paper. And as long as interest rates stayed low, people were okay. And so people were able to go out and get premium financing loans on these Kaizen policies at 3.5%. Now those loans are 8.5%, 9.5%. I talked to a guy the other day. His loan went from 3.5% to 9.5%. And now his whole plan is blown up. And this dude is doing $56,000. He makes $150,000 a year, and he's doing $56,000 a year in premium. Think about this. But out of that $56,000 a year in premium, he's only paying 50% of that for the first 5 years. 50% is getting covered by loans, which now are 9.5%. And then after 5 years, 100% is going to be paid. So $56,000 in premium. He's on the hook for this loan now every single year at 9.5%. Can you imagine being that guy's shoes right now? This is the problem with the industry right now. There are too many people, came up with too many sales schemes that made it look really sexy, and it worked on an Excel sheet for a window in time. And now that window of time is evaporated, all these people are screwed. And that's really what it comes down to. And so what I preach and what I teach and what I educate people to are only principle-driven concepts that will work in any environment, that will put you in control of your money. And this is the reason I love whole life insurance as a savings alternative, not an investment, and not IUL, because IUL is only sold as an investment alternative, right? Life insurance should never be considered an investment alternative. You should never try to utilize life insurance to get great rates of return, because think about it this way. Use some common sense. Sorry, I'm going to go off a little bit here, but like, if we utilize a little common sense and we say, all right, the life insurance company is getting 4.5%. Like, and this is how it's been over the past 5 years with IUL, right? And if we really think about it, really break it down and use our brains and think a little critically, it's not hard to understand. Like, the life insurance company is getting 4% in their general fund. That's what it's been. It's gone up recently, but for the past 5 years, let's just call it 4%. Now, What happens is the life insurance company's getting 4%, and now an IUL agent goes out there and they say, you know what? We've got this great strategy. It's this index universal life policy, and the life insurance company safely and predictably is going to get you 6.5% on inside of your IUL after all taxes, fees, and insurance costs and all this different stuff. Look how sexy this is. I got news for you. If you were able to do that on a safe, predictable basis, the life insurance company would be doing it for themselves. That's about when the life insurance company is earning 4% and they're saying to you that they can get you 6.5% in an IUL after all costs and expenses and fees. Think about that's like the equivalent of the life insurance company probably getting themselves 7.5% to 8% in the general fund. That's effectively getting you double the rate of return than they're getting in their general fund. If they could do that for you, they do that to themselves, for themselves. And the other thing that you think about with IUL is if you were able to go in and positively arbitrage the way that these people talk about with these index loans for tax-free retirement income, all of the smart capital in the world would be flooding to these things, but it's not, right? Like banks would be utilizing them, but they're not. They're utilizing whole life insurance. They've always utilized whole life insurance. My problem with IUL is that they've taken 170 years of success. By the time, IUL became popular, it's 180 years now. But let's just say 180 years of success that whole life insurance has done to create stability and results and predictability and just being there and always meeting their commitments and providing a financial stability kind of foundation for our entire economy, not just for the policyholders. Because if you think about it, the largest holders of whole life insurance in the world are banks and corporations, right? 80%. I read in Barry Dyke's book, The Pirates of Manhattan. I don't know where I put it. It's over there somewhere. But in his book, he wrote over 80% of whole life insurance, he's got all the studies to back it up, is owned by corporations and banks. So to me, if those are the places, those are the people that have them, well, that's where I want to keep my money. And so, they've been doing it for literally 160 years, since before the Civil War. So if that's the case, they are who gives a level of stability to the banks. They are who gives a level of stability to the corporations, right? And so, they're not investing in IUL, and now IUL has come along, and then they start talking about all this safety and predictability. Well, I got news for you. Think about it this way. If you had the choice to be a business partner with somebody or a profit center for that same entity, which would you choose? Well, I don't know about you, but I'm going to choose being a business partner every time. I'm gonna just throw Penn Mutual out there as an example, because they're a mutual company that offers both IUL and whole life. To me, it makes my head explode that they do this. But I'm going to use Penn Mutual as the example. I'm just going to call out a company because it's what I do, right? So, and I like Penn Mutual. They're a fine company. They're whatever. As far as their whole life policies or whatever. But let's just think about this, because I want to give you an example to really wrap your head around. You have a choice to put your money with Penn Mutual. And you have the choice to say, hey, Penn Mutual's been around for all this time. They've never missed a dividend. They're being really successful, blah, 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 blah. I could be a business partner with them and put my money in a whole life policy, or I could be a profit center for them and take away all of the stability and security and guarantees and everything that Penn Mutual really stands for, and say, hey, take the money that you were going to actually give me and then go risk it in options. That's basically what you're doing when you put your money in an IUL contract. That is the mindset. And if give me a 1 if that sounds crazy to you that people would do that, and give me a 2 if you say, no, Chris, you're crazy. That makes sense. I don't understand. It's the hard part. People get so wrapped up in the illustration bull crap, and the fact that these illustrations are never going to perform the way that they're shown. It just is mind numbing to me that people fall for this. And the sad thing is to me is that when utilized properly, whole life insurance is one of the most powerful assets on the face of the earth. We've got our whole opportunity going on in the Dominican Republic right now. I'm launching my real estate investment fund right now. Our Cashflow hacking fund is coming out, and we're doing a $3 million raise. It's a Reg D 506 3C1 fund, which is a private fund for accredited investors only. be checking it out because it's going to be amazing. I'm going to have more information coming out on that soon. But the whole purpose of and the whole ability for me to even create that fund was really based on my ability because I had the flexibility and the capital with my whole life policy to be able to do that, right? Like that's a huge thing. Yeah, exactly. Yeah. So you're a trader and you get it. Like if you understand options, like here's what I'll say to that Vegas style day trading is the crazy part about IUL to me is really all you're doing is you're taking the dividend that the life insurance company would get you and has gotten, and you're letting them manage your risk for your safe, liquid, accessible capital. And you're saying, hey, instead of doing what you do well and doing what you do better than any other financial institution on the face of the earth for 180 years and doing that and get me a good, stable return and foundation for my finances, I want you to take that return, go risk it, buy options with it. Like, right? Like think of like you're handcuffing the life insurance company. That's what you're doing. Like, and when you and to the fact that most people that are invested in IULs have no clue about how options work, and especially how the type of options that the IUL companies are doing, like it's almost laughable. It's sad. It's sad to me, you know, that's happening. So all right, I think I've got that covered. All right, I'm gonna here. I want to do one more little promo here before I go to the next comment. So if you're here and you're an agent, guys, here's the deal. I want to tell y'all I've got a thing. It's called the Life 180 Challenge. We're starting it Tuesday. Text screen. Yeah, exactly. So I'm starting the Life 180 Challenge for life insurance agents on Tuesday. You can go to challenge.life180.com. I'll type it in here. Challenge.life180.com. And you can go there and sign up. Normally, I only offer this to the agents on the Life 180 team on our IMO, but we are opening this up because I want to teach all these agents a lot of the things that we're talking about today, so you can learn how to communicate around this stuff. You learn the product knowledge that you need to know to win the conversation for whole life against IUL. So you know how to market yourself. So you know how to have better conversations and know how to identify the challenges that whole life insurance can solve. So you can then, instead of going out and trying to sell a product to everybody, which is just like really just bad sales, figure out and understand your products well enough so you know what problems they solve. So that way, when you're having good conversations with people, you don't have to lead with your product. You get to ask good questions about them, understanding kind of how your product backs into helping them solve their problems, because whole life insurance is a wildly flexible product that can do a lot of different things that will grow with you as you age and go through your business career and real estate investment life cycles and all these different things. And so, you know, I would just say go to challenge.life180.com if you're interested. If you're a life insurance agent, you can also go to planner.life180.com. And that will get you through where you get the planner, which is the foundation of us going through the challenge. And then we'll give you an upsell after the fact, full transparency for the challenge. To do that, it's at the end of everything, it's like $197 to do it, which we're doing 2 meetings a day from this week through the end of the year. It is the best deal on the face of the earth. Like if you are looking to get to 6 figures running your life insurance business, my guarantee in this is that if you show up and you do the challenge now, and then you utilize the planner and you follow the coaching that we give you, and you prove that you're showing and that you're doing it every single day, and you don't hit 6 figures next year, if you do not hit 6 figures next year, I will give you 50 high quality leads that are worth $1,500 in value. So I'm asking you to take a $197 risk on the program. And if it doesn't work by the end of 2024 and you don't hit 6 figures following what we teach, I'm going to give you $1,500 worth of free leads, quality leads that are generated by our channel, generated by our book, generated by all the things that we do that we do to drive millions of dollars of revenue every single year. And so, that's how much I believe in this. You just got to believe in yourself, and you got to like get out of your own way, let your ego get put aside, so to speak, and just, be willing to be vulnerable with people, be willing to do these things and think about this business through maybe a little bit of a different lens. And I think the challenge will be an amazing help for anybody. So I encourage anybody to go to planner.life180.com. You can get the planner, upgrade to the challenge. But if you already have the planner, just go to challenge.life180.com and you can sign up directly there. So let's get back into some questions or comments. Somebody called me a crybaby. I would love to see what I did. What was this video? The difference between whole life and IUL. Oh yeah, this is the one where I was talking about being a profit center or being a business partner. Somehow me explaining that to people makes me a crybaby. That's interesting. Funny. What is the risk of an IUL? That is too long. I put the comment there. That's too long of an answer for this video at this point in time. Did I make a video recently not totally agreeing, but someone wasn't aware of certain stuff in IUL that you found appealing? Yeah, this is what I was talking about earlier in this live video. So if you're just getting here, maybe watch a replay. I kind of already addressed this comment accidentally, I suppose. But it was talking about how you can utilize, I guess actually somebody asked the comment in the chat here is where can IUL, is there a scenario where IUL can actually be a better fit? Mark Perry asked that question. So that is where you could do the single pay MEX in retirement for legacy planning. Sometimes there could be more leverage and it can provide more death benefit from a legacy play than a whole life policy will actually provide for you. So that's something to think about. Oh, what do we got here? To be honest, I'm very confused. Oh, wait, no, because this is just a continuation of that comment. I got to get back down here. Okay, so I said IULs don't, this is a video I did, IULs don't give compound interest. And then I did laser fund and MPI because those are the two, I think, biggest scams going right now when it comes to IUL. Maximum premium indexing with Curtis Ray. The flex method, by the way, somebody, I think Vegas style day trading here, you were talking about the flex method. Flex method is basically like MPI. They're both just effectively the same thing done in a bit of a different way. Obviously, nuanced differences in the way they're marketed and the way they're executed. But ultimately, they're both just horrible. So Rick Sanchez says, bad argument made on semantics because I said IULs do not give compound interest. By definition, compound interest does not mean you never have a negative year. It just means you gain interest on your interest. Ideally, you never have a negative year, but that's not a requirement of compound interest. Okay. How about you sell whole life purely based on its merits rather than by intentionally misrepresenting IULs in every video? While you sometimes make good points, most of the videos are pathetic. I have a fan. Well, here's what I'll say. This guy obviously doesn't know what he's talking about. How do I say this? I'm going to try to take the high road and be nice to this guy. So here's the deal. Sure, he's not wrong. Compound interest does not require, not having losses. It's technically just earning interest on your interest. But when you're talking about when you're looking at the marketing for IUL, they're not talking about just regular compound interest. They're talking about uninterrupted compound interest, talking about the idea that you can never lose money in an IUL due to the 0% floor. And so when we look at that and we think about it through that lens, then IULs are wildly misrepresented because you absolutely can lose money in an IUL. One of the things I want to show here, I want to do this. I actually just did this I had Tom Wall, who's a PhD in retirement income planning over at my house. And I've got a couple of videos coming out this week that are going to be with Tom because Tom was in my studio here. And we were going through some of this stuff and I was showing him some stuff on IULs. I want to see if this is the page. Nope, no, it's not it. I got to get to the right page here, guys, because I got to show you. This is just, this is so important to understand. And I want to take this and I want to show it to you. Okay, so this is what I'm going to show. So on YouTube, if you're on TikTok, sorry, it's probably not going to be very noticeable. On YouTube, I'm going to just share. That way you see everything. I'm going to just delete this so we can have a fresh conversation. I love this board. So all right. So here's the thing. When you're looking at oh crap, I went one page too far. I got to do this. Oh, my bad. Sorry guys, bear with me. I wasn't prepared to do this. So when we look at you know, an IUL policy, when they say they can't lose money, I was talking about this earlier in the day, and we were talking about the fact that you can lose money in an IUL. You can't lose due to market loss, because you're not losing the money in market losses. You are losing because of market loss, though, because of the fact that we are always buying. Remember, whenever you're buying an IUL, typically this is how it's sold. It's being sold to you for tax-free income retirement. My problem with the flex method, my problem with MPI, is they're taking this and they're injecting the index loan risk starting in like year 2 or 3 of the policy, right? Like, so even in this situation, we're talking policy year 1 doesn't start taking policy loans till year 21, and you know, I'm going to show you how the wheels fall off this thing. Now, what do we have here? The important thing to understand with IUL illustrations, and this is so vital, is that they always are using index loans, because index loans allow for 50 basis points of positive arbitrage. Okay, so 50 basis points positive arbitrage. What does that mean? What does it look like? And I love this illustration simply because it illustrates very cleanly. It shows the loan charges and the loan credits. So you can see here in year 21, you have $1,026 of loan charges, but because you have 50 basis points of positive arbitrage on that loaned money on this $37,000 loan, you have $1,168 of loan credits. So this happens every single year, this 50 basis points of positive arbitrage. The problem is 35% of the time, at a 5% loan rate, okay, 35% of the time, the policy is going to perform worse than this 5% loan rate, right? So if it does that, what happens is, rather than having a positive arbitrage and a positive credit, it's going to be negative. And so it's going to actually pull from the cash value over here, making your cash value worse, making your net amount at risk higher, increasing the costs and the fees. This is why the whole relock feature in MPI is an absolute laughable joke. And this is why the flex method doesn't work, right? And so when we look at this, and this is so vital to understand, it's like people always talk about IUL as a cheaper version of whole life, right? And they go, oh, well, you know, that's fine. Here's what I'll say. During this period of time, the cost of insurance will be less in IUL than whole life. I'm not going to argue that. That is what it is. Because we're talking about whole life insurance is taking the whole death benefit, guaranteeing it, and spreading the mortality charges over a period of time, and they're more level, right? I'm not going to say they are level, but they're more level, right? They're more flat. With index universal life, you're utilizing an annual renewable term. So every single year, you know, the cost of insurance goes up and up and up. However, when you're 40 to 60, the mortality risk is very low for the insurance company, and so it's cheaper. As you get older, when you hit 60 plus, that's when the insurance costs start to go up. And now that's obviously when you're starting to think about retirement income. Unless you are in MPI or flex method, you start injecting that risk up here, which is just disgusting to me. It should be fraud, in my opinion, that people are even able to do that. And I think it's just going to turn out to be horrible. That's just my opinion. But here you can see, as we look at this, you can see you've got $189,000 of income after 5 years, and you have $215,000 of outstanding loan balance. So that means even though you took $189,000 of income, you basically had an extra year of income due in loan balance already. Now, even with this positive arbitrage, here's what I want you to keep your eyes on. This 423 goes down to 414, down to 404, down to 494, 394, 383. So the cash value in the policy is still going down even with the positive arbitrage. So what's it going to look like on years where we don't have more loan credits than we have loan charges? What's going to happen? And so let's go to the next page here and look at it as this plays out, as it gets a little older. And this, by the way, this is the Allianz Life Pro Plus Advantage, which is the most popular IUL sold on the market right now. Ironically, it happens to have the highest compensation schedule as well. You can tell me if you think that's a coincidence or not. I certainly don't think it is. But you know, people like David McKnight at the Power of Zero, he loves this product. In fact, this is, there's another guy, Steve Barber, Oregon Cashflow Pro, who, we've been disagreeing a lot about this stuff. He loves this product. This product is pathetic in my opinion. But here's the deal. When we look at this, check this out. So we have the index loan keeps going, right? So by the time you're 75, you have $568,000 of income. This would be your income. Now, at this point in time, you have an outstanding loan balance. You've had loan charges annually of $271,000, but you have a loan balance of $839,000. Now, this is the crazy part. My wife, my grandfather's been dead for a long time, but my wife's grandfather is 84 years old. He's having his birthday. We're actually planning an 85th birthday party for him coming up, and he's a healthy dude. He's still cranking along and doing awesome things, and I just think about, what if he were in this position, right? What if he were in this spot where, like, he bought this as a solution to his retirement planning problems, and then all of a sudden, $37,000 of income is what he's relying on, and he's got $839,000. And by the way, in order to get to this place, we're assuming, even though 35% of the time it's going to perform worse than what we're seeing here, we're assuming that this just performs well every single year, right? Which is just ridiculous to me. But even if it did well and performed better than 5% every year, and there was positive arbitrage, which it won't be, but even if it did, we only have $280,000 of cash value left. Now, let's say the first year that it did poorly was when he was 76, right? So he had that $37,000 of income, so he was able to take that. He's got his $43,000 of loan charges, but you know what? Because the market did zero that year, and not even negative. Let's not even say the market did -10. Let's just say it had a flat year. If it does zero that year, there's no more loan credits. So actually, I'm going to do it this way. There's no more loan credits. These loan credits are not there. They go away because you didn't have positive arbitrage. You did not have any gains in the index. And so now you have this outstanding loan balance of $920,000. Let me get oh crap. My phone's being used for TikTok right now. I'm going to round number this out, and we'll do the math, and we'll figure this out. So $920,000 at 4% is basically like $18,000 bucks, I think. So like, you're talking about an $18,000 5% loan. Oh wait, no. Here we go. No, I'm so bad at math. I'm so bad at math right now. I'm just thinking about too many things at once. That's what happens when I go live. I look foolish sometimes. So loan credits were the 49,000, but the loan charges are 43,000, right? So now what's going to happen is you don't have these loan credits, so those go away, but you are stuck. This $43,000 of loan charges has to be paid out of the cash value. Okay, so now you have 271 minus the 37 minus the 43, right? Minus the fact that you're not going to have these credits be credited in here, minus the 49, right? And so what do we have here? We have 271 minus 30. Well, what do we have? I'm going to just add these up instead. We got 10, 19, 1, 4, 8, 12, 129. So we go 271 minus 129. 6, 11, 2, 4, 1. So you got $142,000. So now all of a sudden, you only have $142,000 left with one bad year at the wrong time. If we have 2 bad years like this in a row, not even bad, just flat years that we're kind of experiencing right now. If you had this policy and you bought this 40 years ago, and 36 years ago, IUL is not even this old. This is one of the things, like, I try to show people, if you understand how this works, IUL isn't even old enough for us to go through and experience this yet. So everybody talks about it like it's this great saving grace policy style structure. But the bottom line is, it's a financial experiment, and it's a failing financial experiment at that. And so when we look at that and we understand, listen, there's no arguing with math. I mean, and it doesn't matter what program we're talking about, what policy it doesn't matter what policy we're talking about, if it's Pac Life or if it's this Allianz product, or if it's Mutual of Omaha, or if it's Penn Mutual or Emeritus. They all work the same way at the end of the day, and that's what I think is important to understand. So all right. So what company do I suggest? So I'll tell you this: we work with 5 companies. There's compliance reasons I'm not really allowed to get in, because the companies that we work with, I'm not allowed to go into specific companies right now. Here's what I'll say though, is that we work with 5 companies. And the reason that we're independent and we work with 5 different companies is because all 5 companies have their benefits and all 5 companies have their negatives. So rather than tell you a company, because I do not want you to feel like I'm kind of skirting around this answer, I will give you some things to consider. I've done a video on this before, so you can go find the video if you want a more long, drawn out explanation. But what I would say is you have to think about what are the levers that you want. What levers do you place importance on? So you want to be thinking about, first of all, you want to be thinking about the PUA charges. That's going to be important to understand. You want to think about PUA flexibility. You want to be thinking about blend options, because not every company allows you to do the same types of blends. You want to be thinking about your front load options. If you have money that you can dump in to a policy, you want to contemplate that. You want to be thinking about, what do I have here? What have I done? Oh yeah, living benefits. That's one thing where IUL is much more clean across the board, is they have living benefits, accelerated benefit riders very cleanly on every single policy. Pretty much all major carriers with IUL have great living benefits. That's the one area that consistently across the board they have it. But with whole life insurance, you have different companies offer different levels of living benefits. I personally am a huge advocate for the importance of living benefits. I've been sharing the story of my father-in-law as a reason why, so you could understand that. And if you want to go, I've made videos on this before. But these are the things that you need to consider. And so it really is, when somebody goes, what's the right company? The answer is, I don't know. It depends on you. What I can say is that if you go to life180.com/clarity call, you can have a clarity call with somebody on my team. With one of the coaches on my team, even me, sometimes I end up hopping on those calls every now and then. I wouldn't say that's something you can bank on, but I do try to hop on whenever possible. What I will say is, that clarity call is designed to help you work through all this different stuff, to understand your personal financial situation and what policy is the best fit for you. I guess the only thing I'd say right now to as I wrap this up, as far as this goes, is I genuinely am a believer that if you understood what I understand about this stuff, you'd be doing it. And that's why we don't focus on sales. We focus on education. We focus on these clarity calls to be able to give you clarity about your scenario, because there's so much bad information on the IUL side. I even think that, we're always looking for agents. If you're the right agent, I'm always looking for agents. We're up to over 200 agents on the team right now. It's been growing really, really fast. We started the IMO as a way to help save people from PHP and WFG and stuff like that. And it's kind of grown and taken on a life of its own. Over the past year, we've grown by over 200 agents in 2023 alone. So it's pretty amazing. But yeah, we are looking for the right agents. But I'm pretty hardcore about making sure your mindset and philosophy is in alignment with what we practice and what we preach and what we teach and all that stuff. Vegas style day trading, I don't know. I mean, if you're licensed, you can absolutely reach out. Anybody who's interested can go to agent.life180.com and you can set up an interview on there, and you can do a deeper dive. But once again, if you are an agent, anybody who's an agent, I'm telling you right now, go here. If you're just getting here, go back and watch this. I talked about it a lot. I'm going to have to bounce because I actually have to Vegas style day trading. I actually have to get in my car and drive up to Vegas right now. I'm getting a tattoo tomorrow. My first tattoo. It's a long story, but I'll be documenting it on Instagram. So anybody not following me on Instagram, go follow me on Instagram there. And if you're interested, it'll be fun. I'm going to document the whole creation of the tattoo tomorrow. It's something that yeah, it's a long story. I don't even think I can get into it right now, but really excited about how things are going. Excited about this challenge. If you're an agent that's looking to join a team and whatnot, well, then we're here for you. You can reach out, and we're happy to help you build your business. If you're independent or if you're with another company and you want to just do it on your own, I would say go get the planner.life180.com, and go to there and set up, go to planner.life180.com, just like I show it there, and get the planner, join the challenge, join the group. 2 days a week from here to the rest of the year, we're going to help you build your business and do everything you need. You're going to see a metamorphic shift in your ability to show up for your clients as a life insurance agent. And I open that up even for agents that are not on the Life 180 team. So anyway, that is it. So, all right, guys, I got to roll. My wife is getting on me right over there saying that I got to go because we got to get in the car and drive. So hopefully everybody found value in this. If you did, please like it, share it, get it out there, subscribe, hit the bell, all that fun stuff. That's awesome. Oh boy, Michael, you got me with a question right at the end here. How would I structure a plan? I would say, Michael, I would say just go set up a call, and my team can help answer that question for you. They're happy to answer it. Like seriously, no pressure to buy anything, but I would say go there. They'll help you answer it. Every company is a little bit different. Different companies, when we talk about the companies we work with, some of them are much better for juvenile policies, as they call them. Every juvenile policy, yeah, don't do Gerber. Yeah, no Gerber life. That's definitely a no-no. But we use 3 different companies for juvenile policies because not every company is good with juvenile. They don't offer the liquidity. They don't offer the design ability. At Real Chris Kirkpatrick is my Real Chris Kirkpatrick. If you go to Instagram, no double C's there, but yeah, at Real, then my name, Chris Kirkpatrick, is on Instagram. Go check me out there. Everything's going to be there. And that is that. All right, guys. Well, hopefully everybody found value in that. Please, share this out with people. Appreciate you being here. Have a blessed, inspirational day. We will see you on the next video.